Hello and welcome back. I hope that you are doing well. If you are new here, my name is Jessica Abella. I am a tax accountant in the greater Seattle area. And today we are going to talk about Roth IRAs, and more specifically, we're going to talk about the Backdoor Roth IRA strategy. So first, to back up, what is a Roth IRA? You may have this option in a 401k account as well. Roth options mean that you pay tax on the dollars when they go into the retirement account. They grow over time, and when you take money out of the retirement account, every dollar, including the earnings, is tax-free. That's a huge tax benefit. Your traditional accounts, the traditional 401ks that you've known in the past, the deductible traditional IRA account, you take a tax deduction for the money going in, it grows tax deferred, and then in retirement, every dollar coming out is taxable. It's good to have a balance of both kinds of funds when you get to retirement, but today we're really focused on Roth because the goal for many people is to get as much money into Roth as possible. One thing to know about Roth is that if your income is over a certain threshold, you're not eligible to contribute to a Roth IRA. You can still contribute to the Roth portion of your 401k at work, so definitely max that first. Your traditional and Roth IRAs outside of your 401ks have a much smaller limit, and so you really only want to tackle those after you have tackled your 401k at work. So back to this IRA contribution. For 2025, you can put $7,000 a year total into an IRA account. It can either go into a traditional IRA, it can go into a Roth IRA, or you can split it and put a total of $7,000 between the two. However, if your income is too high, you can't contribute to the Roth at all. And if your income is too high, your contributions to a traditional IRA may not be deductible. The workaround is to put the money into a traditional IRA. It may be not deductible. We don't really want it to be deductible in this case anyway. And then to turn around and immediately convert those funds into a Roth IRA. It's silly. It's an administrative headache, but it does work. It is a way to do a Roth contribution correctly when your income is too high. If you contributed to a Roth and you weren't supposed to, your income was too high, and you didn't do this backdoor Roth, you're required to take the money back out again. So follow the rules. Do it the right way if you need to do it this way. Let's talk for a minute about putting the money, doing this conversion, this backdoor Roth, this conversion from traditional to the Roth IRA, because it's not quite as simple as it sounds. If you have no other traditional IRA money, you don't have a traditional IRA open with any funds in it, you don't have a SEP IRA, you don't have a simple IRA, you don't have an IRA account that has pre-tax money in it, then it's simple. You open a traditional IRA, you do the $7,000, you convert it right away, there's no tax impact, piece of cake. If you don't do it right away and the funds grow, between the time you do the $7,000 contribution and the time you do the conversion, you do pay tax on the earnings in that conversion process. But again, that's pretty simple. Where it isn't simple is if you do have other pre-tax IRA funds. Most of the time, those are from rolling over an old 401k into a rollover IRA. That's where we see it the most. In that case, you would think that the IRS would allow you to say, I'm converting this $7,000 that I just put in this IRA, and so it shouldn't be taxable. It doesn't work that way. Tax law is rarely that simple. So let's look at an example of how it does work and how you end up paying tax on part of this backdoor Roth conversion, and B, how you recover your tax-free funds over time. So we're looking at an example today where there's a balance in this traditional IRA account of $13,000. It's pre-tax money. It hasn't been taxed before. In 2025, you contribute that $7,000 because that's what you want to convert into the Roth. So now you've got a traditional IRA with $20,000 in it. You've already paid tax on the $7,000. You haven't taken a deduction for that, but the $13,000 you have not paid tax on yet. So if you converted the whole $20,000, just to keep it simple, right? You want to get rid of this pre-tax money and just convert the whole thing, convert it all to Roth. you can do that. You'll pay tax on this $13,000 that hasn't been taxed yet. So that, again, pretty simple. It's less simple when you just want to convert the $7,000. So we look at, throughout IRS Form 8606, it does this math that says, okay, you have $7,000 in this $20,000 that you have already paid tax on. So 35% of this account has already been taxed. So if you convert this $7,000, $2,450 of it is going to be tax-free. It's part of those funds that you've already paid tax on, which means of your $7,000, you're going to pay tax this year on $4,550. Still, it makes sense, I hope. And then as you go into year 2, if you do this again the following year, you contribute $7,000, you still had $4,550 that you have already paid tax on that's sitting in that account. So now you've already paid tax on $11,550 of the, let's say the balance is again $20,000. We've got no appreciation in this account. So in year 2, $11,550 of the $20,000 assumed balance, 58% of the money sitting in that account you have already paid tax on. So in year 2, if you're converting that same $7,000 again, or that, I guess, year 2's $7,000, you're going to not pay tax on $4,043 of it. You are going to pay tax on $2,958, and you've got about $7,500 left, again, in that account that you have already paid tax on. So this is just a rundown of kind of how the math works. I do get asked this quite a bit as people are trying to decide whether to leave the money in, to just convert it all, to just skip this whole thing and not do a contribution at all. Hopefully this kind of gives you an idea of how it works. In the end, you don't pay tax on the dollars twice. Super important to keep track of contributions into a Roth account and after-tax contributions into a traditional account to make sure that you don't pay tax on those dollars twice. So hopefully this was helpful. I did do a video a while back comparing, again, traditional and Roth, and I will link that down below. Let me know if there are questions on this video or other topics that you would like to know more about. I'll leave those in the comments down below. Click like if this was helpful and subscribe if you would like notifications. I post every other week and shorts on Fridays. Have a fantastic rest of your day. Thanks for watching. Bye.